Told you that the revolutionary market structure concepts that you're studying right now were actually discovered before your great-grandparents were even born. Every institutional trading principle you're trying to learn, trend structure, reversals, break of structure. Charles Dow wrote about this in the late 1800s. I'm Raghee and I've been trading for over 35 years, and today I'm showing you why Dow Theory is the foundation that turns confusing charts into clear, confident analysis. Stick with me because I'm about to show you why learning strategies without understanding the foundation leads to 90+% of traders failing or quitting in their first year. And at the end, I'm going to give you the exact 3-step process I've used for over 35 years to align every trade with institutional flow, no matter what strategy you're currently trading. The single mistake that makes retail traders fly blind is easily fixed in confusing retracements with reversals. You may think you know what they are, but if you don't understand market structure at the foundational level, these will look identical to you. And that is a big problem. Let me explain what I mean. Let's say you're in a long position. Price pulls back hard. You panic sell thinking it's reversing. 2 days later, price rockets back up. You sold at the worst time. That wasn't a reversal, it was a retracement. It's almost as if you gave up digging for treasure 1 foot from success. The key difference is this. A retracement happens on declining volume. It's profit taking. Early buyers are cashing out. The trend is just catching its breath. Reversal, on the other hand, comes with increasing volume, pattern breaks, and a fundamental shift in who is in control. Now, most traders, instead of learning the difference and understanding structure, try to solve this by adding more indicators like the RSI, MAC Bollinger Bands, the list goes on. But indicators are all lagging. If it needs price, it cannot lead price. They're built from historical data. And by the time your moving average confirms a trend change, institutions have already moved. You're basically watching the game on replay and still trying to place bets. The game's already over. But price action, it doesn't lag. And neither does market structure. So when price breaks a key structural level and closes beyond it with volume, that's the beginning. That's happening in real time. That's front row information. And this is exactly where modern strategies fall apart. Traders chase breakouts without understanding the structure behind them. They see price above resistance and they buy ignoring that the breakout happened on weak volume with no institutional backing. That's a fake breakout, or a liquidity trap, or a whipsaw. And Dow Theory teaches you how to spot it before you lose a single penny. But how can you tell the difference? That's where the Dow's core 3 principles come in, and the first one changes everything you know about how to read time frames. Charles Dow identified 3 simultaneous movements happening in every market. And here's why this matters so much. Most traders today look at structure in isolation. They see a BOS, or a change of character, a sweep, but they have no idea which move matters. Dow gives you context, hierarchy, and weight, something modern terminology doesn't provide because it's incomplete. The first principle, the 3 market movements. Think of the market like an ocean. You've got the tide, the waves, the ripples, all happening at the same time. Understanding this hierarchy is crucial because most traders mistake a ripple for a reversal. Dow prevents that. The primary trend is the tide. The major direction can last months to years. Fighting this destroys accounts. It's almost as if you're swimming against the ocean. If the daily trend is down and you're focusing on 5-minute bounces, generally you're betting against institutional capital flow and you won't get a lot of follow through. The secondary trend are the waves. These are pullbacks within the primary trend. These can last weeks to months. This is where traders panic. But if the pullback holds structure and volume declines, it's just the market breathing. That's your entry, not your exit. Finally, the minor trends. They're ripples. They're sometimes the intraday noise where the day traders live, and manipulation happens the most. Stop hunts and liquidity grabs live right there. Dow said the primary trend can't be manipulated, but the minor trends absolutely can. Principle 2, trend confirmation through structure. A trend is only confirmed when price breaks the previous high in an uptrend or the previous low in a downtrend. This would be known as follow through. The exact sequence is this: higher highs and higher lows confirm an uptrend. Lower highs and lower lows confirm a downtrend. Understanding this protects you from reacting to every wick, fake breakout, liquidity sweep, or news. Dow's structure rules add precision to the ICT labels. Principle 3, volume confirms direction. In a healthy uptrend, volume should increase on rallies and decrease on pullbacks. If price is rising but volume is falling, that's not strength, but a rally held together with hope and retail optimism. This matters because often traders, including ICT traders, often focus on levels but ignore the fuel behind the move. Dow makes sure you're trading with participation, not hope. Now, if this is starting to make sense, or if you're seeing how the foundation connects the dots, hit that subscribe button. I break down institutional trading principles like this every single week. Becoming consistently profitable is a journey, and I'm committed to walking that path with you, however long it may take. Until these concepts become second nature, I don't want you to miss out. Now, here's where it gets interesting, because every modern concept you may be studying is built on these next principles. How modern concepts are really just Dow theory in disguise. You might be looking to a break of structure, order block, or fair value gap, thinking you're learning some cutting-edge institutional concept. But let me tell you this, if you understand the classical foundation they're built on, you'll already be 10 steps ahead of 95% of traders out there. Break of structure equals violation of Dow's trend structure. When ICT traders talk about a BOS, or break of structure, they're describing the moment price closes above a previous swing high in an uptrend or below a swing low in a downtrend. This is Dow theory. Dow said a trend exists when price penetrates the previous high. Same concept, different name. And a CHOC, or a change of character, that's the first time a higher low gets violated in an uptrend. Dow called this a failure swing, the first warning that the primary trend might be reversing and going into chop. The key here is the close. A wick breaking a high isn't a break of structure. It's a liquidity sweep or a manipulation. But a candle body closing above the high, that is confirmation. Dow explained this and discovered this over 120 years ago. An order block is the last opposing candle before a strong, impulsive move. In SMC, traders see this as institutional buying or selling, but this is just Dow's accumulation phase. Institutions can't fill massive orders at just one price, so they accumulate liquidity over a range because they need the liquidity to fill the orders. When price returns to the zone, it reacts because institutions defend their earlier positions. A fair value gap is simply a chunk of price where no trading occurred, an inefficiency price often returns to. Dow called these runaway gaps, moments where panic buying and selling wiped out liquidity. The insight is this: the gap magnetizes price, but Dow's trend context tells you whether that fill will bounce or collapse. In my opinion, it's important to know the source all of this stems from, as it helps every modern concept become more obvious. And remember, this means these are very time tested. You can go back over decades of charting and see this phenomenon. This way you stop chasing new strategies and start recognizing the same pattern happening everywhere over and over again. Now, remember at the start, I said I'd give you the exact 3-step process I've used for over 35 years to align every trade with institutional flow, thanks to Charles Dow? Well, here it is. This is the exact 3-step process I use on every chart, every market, and every trade. Step 1, identify the primary trend on the time frame you're going to trade. Go to the weekly chart if you're looking at a longer term hold, a daily chart for swing trades, or perhaps a 5-minute chart for day trades. Is that chart making higher highs and higher lows? That's an uptrend. Lower highs and lower lows? That's a downtrend. A choppy mess with no clear structure? Dow called that distribution. Typically, I will tell new traders, do not trade distribution chop. Finding your directional bias is key, and that's going to be best usually in uptrending environments. If the chart is bullish, you're only looking for long position. Trading against a primary trend cuts your win rate in half. Essentially, you're top picking. Don't do it. Step number 2 is wait for the secondary reaction, that holds structure. So what you're doing is looking at that weekly chart, that daily chart, or that 5-minute chart, and you're looking for support. Wait for a pullback within that primary trend. It's a higher low in an uptrend. It could be a retracement. It could be a support level. This is where traders fail. They chase the high instead of waiting for the pullback or the retracement or a test of support to buy. This pullback is your entry. Yes, we're talking about buy the dip. It's not a meme. It's something that's worked for over a century. Step number 3, enter when there's a minor fluctuation, confirming the trend is resuming. Keep this in mind. This is something Dow said for a really long time. Continuation is much more probable than a reversal. So go back to your 5-minute chart for day trading, your daily chart for swing, or your weekly chart for a long-term hold. Look at that chart. Wait for price to show you it's ready to resume the primary trend. In an uptrend after the pullback, you want to see that price held that level. Even better, maybe there's a wick or a shadow below the candlestick body. Maybe there's an inside candle or a minor low that's formed at support. You're wanting price to break back above that near-term resistance, test support, and show that the buyers were actually there willing to buy. That is your green light. And always check the volume. I prefer price-based volume. So you can look at things like an anchored volume weighted average price. You can look at volume profile. Is volume at that price level? Are you trading with the size? Also, you can take a look at volume for that session. Is it expanding on the breakout? If it's increasing, yeah, institutions are participating. If it's not, it's likely a low liquidity trap. So now you can see it. Dow Theory isn't just in some dusty old textbook sitting on a bookshelf. That's the foundation almost every trader uses, whether they know it or not. And it makes sense on every single chart, intraday, end of day, long term. You're going to see it wherever you look. Understanding this concept is what separates traders who guess from traders who know. 6 months from now, you're confused by every new concept that pops up on your YouTube, or you're the trader who sees through all of it because you understand the foundation. So imagine 6 months from now, either you're confused by every new concept that pops up on your YouTube by the newest influencer, or you're the trader who sees through all of it because you understand the historical, time-tested, century-old foundation. Here's what mentoring looks like in my live trading community. We review our actual trades. I send out alerts on the trades that I'm setting up with the concepts that I'm teaching you. I show you where things are in line with Dow's structure. Are we trading with the trend? Are we trading at key levels? Or are we just guessing? Are we ignoring volume profile? Are we ignoring anchored volume weighted average price? Are we trading with expanding volume or contracting volume? Have we confused a retracement with a reversal? Or is this just a dip in an ongoing move higher? You're going to learn to recognize these very easily once you master Dow Theory. And with that in mind, I look forward to seeing you in the next video.